Good evening. Tonight is Tuesday, February 12, and group assignment 1 is due. There was a question just now. Somebody wanted to ask me, who was it?
Oh, yeah. I was just wondering, you know how like you post the solutions online to like the questions, the practice questions?
Yeah.
Is it possible to maybe post questions as well? You don't have to textbook?
I put the textbook on reserve at the library, so you can just go see them at the library. Anything else? Okay, so group assignment 1 due right now. The solutions will be posted either over the weekend, early next week. I can't post the solutions right away because the other sections has it due later in the week, so I can't put up the solutions until everybody's handed their stuff in. But as soon as that's done, I'll put them up on CU Learn. So there's one missing announcement. I forgot to put it on there. Next week is spring break, so no lectures. Then the first Tuesday after spring break is the midterm. It's in this classroom, 6:30 to 8:30. So it's 2 hours. And since people are sometimes a little bit tight with night classes getting here after work or something like that, so I usually start, because we only need the 2 hours out of the 3 hours thing. So we're gonna start at 6:30, but we're gonna start at 6:30 sharp. So if you get here at 6:45, you don't get an extra 15 minutes at the end. It's on all the chapters up until last week. So 2, 10, 11. The part of 14 that we did, which is dot 5 and dot 6, which was on divisional cost of capital and flotation costs, and then all of 15. Half multiple choice, half written problems. Formula sheet allowed. Double-sided, open rules. You just put whatever you want on there. There's a sample midterm and the solution. So one of the PDF files is just the plain midterm, and then the other PDF file is the midterm with the solutions in it. And that's posted on CU Learn in the quiz midterm final folder. Suggested exercises that we were talking about before for the 6th and 7th edition, they are, it said posted on WebCT, it should say posted on CU Learn. How many people have used those so far? Yeah, well, I suggest you use those because we put quite a bit of effort, me and the TA, to type up the solutions, and I picked all the questions out of the end of the chapters that would be most relevant. So that's by far the best way to start studying. That and the slides and the examples in the slides and the notes, yeah.
I have a question about the midterm. The sample midterm on CU Learn has a formula sheet as the first page, so basically all the formulas we've used so far were on the midterm.
Yeah,
as well.
Last time I was doing the formula sheet, but this time we're giving you a formula sheet. Who prefers, we're not really sure who likes what better, but who prefers to be given a formula sheet and who prefers to make their own? So yeah, it probably makes more sense to make your own. But usually, you got the extra work of having to make the sheet. Yeah.
Is that formula sheet online all you need for this midterm too?
It should be. I would say 99% sure that it is, yeah.
Can we print out that formula sheet and write on it? And how does that
You got double-sided, you do whatever you want with it. So you can print that, you can print all the slides in 2-point font, whatever you want to do. So, and the PDF slides and the notes are posted also on CU Learn. So any questions at all about anything? Midterm, group assignment, anything like that? Okay. So tonight I'm going to start chapter 16. This is, I would say, by far the most difficult chapter in this course, maybe together with 21. So that's why I do those 2 chapters over 2 weeks instead of 1 week, because trying to do it within one lecture, I'm going way too fast. It's not very good teaching practice. So tonight I'm going to go through as much as I can of this, and then in 3 weeks from now, because we got spring break, then we got the midterm, then we got the next class after that's going to be the continuation of 16. So I'll do a little bit of review. This is a chapter that's kind of worth going over, twice, just because there's so much. Like most chapters, there's like 1 or 2 main math problems in the chapter. So you take chapter 16, it's about the rights offering. You take, say, chapter 10, it's about equivalent annual cost, bid price, those kinds of things. But in chapter 16, there's almost every single one has some pretty big math in it, especially dot 2, dot 3, and dot 4. So it's a chapter that's actually worth doing a little bit slower so that people have a bit of an easier time. So let's talk about capital structure. Capital structure is the mix of debt and equity, and possibly preferred, that you use to finance your company, to finance the assets. A capital restructuring is where you're changing that mix. So it could be that you're going from being financed all equity to half equity, half debt. It could be that you might have, say, 80% debt, 20% equity, and you want to reduce your debt, so you'll raise new equity and then you'll use that money to pay back some of the bonds. Restructuring involves changing the amount of leverage a firm has without changing the firm's assets. So right now what we're doing is we're not talking at all about the left side of the balance sheet assets. We're just talking about the right side, the liabilities and the equity. Leverage means, we've talked about before in chapter 11, operating leverage. Here the leverage refers to financial leverage, which is the amount of debt that you have in a company, and you'll see why that's called leverage once I show you the effects that having more debt or less debt has on the earnings of a company. So you can increase the leverage, in other words, have more debt by issuing new debt and using that money to buy back shares. The opposite is that you can decrease the amount of leverage by raising new equity and taking that cash and paying back your debt, or some of the debt. So, how do you choose a capital structure? Should I finance my assets all with equity? Should I have some debt, some equity? Should I have mostly debt? So what is the primary goal of a financial manager? It's to maximize the stockholder wealth. In other words, to maximize the cash flow that the company generates and also minimize the risk. So you want to choose the capital structure that will maximize the stockholder wealth. And you maximize the stockholder wealth by maximizing the firm value or minimizing the average cost of capital. Because in general, there's some small details we're going to talk about, but in general, a company is worth, or just any piece of financial paper is worth the cash flow that is generated divided by the cost of capital to generate that cash flow. So if you think of a fraction, just think of cash flow at the top. There's several measures of cash flow, but we're going to talk about EBIT in a sec. Cash flow divided by the cost of capital. So if you want to increase what the value of that fraction is, you can do 2 things. You can increase the cash flow, or you can minimize your cost of capital. both of those will increase the value of that fraction. So how does leverage affect the earnings per share and the return on equity of a firm? When you increase the amount of debt financing, you increase the fixed interest expense. If you have a good year, you can pay the interest and there's money left to the shareholders. If you have a bad year, you still have to pay that interest, right? The bank doesn't care that, I don't know, you lost one of your employees or whatever. They want to get paid. So once you have debt, remember that that's the main difference between debt and equity. Debt you have to pay back, and there's interest and there's principal. And if you don't make the interest payments, and if you don't make the principal payments, your creditors take you to court and they put you into bankruptcy. Leverage amplifies the variation in both earnings per share and return on equity. Here's a very simple example to illustrate that. If I buy a house for $100,000, obviously, it's not quite realistic, but let's just say you buy a house for $100,000. You have people in there that are paying you $10,000 a year in rent. So the return on that investment is 10,000 divided by 100,000, it's 10%. So that's with no debt at all. Now, if you go and you buy that house, say where you put in 50 of equity, and then you put in a mortgage for the other 50, then your investment is 50,000. You're going to receive the 10,000 in rent, and then minus whatever the interest is on that debt, whatever's left, say there's 8,000 left. Now you have 8,000, 8,000 out of, actually I'm going to go back to, the rent is 12, and so the unlevered return when you have no debt, let's write it this way, maybe if I write it out. So unlevered means no debt, and levered means with debt. So you buy the house for $100K. In either case, you pay the same price for the house. So in this case, it's all equity. In other words, for unlevered is all equity, an all equity firm or an all equity deal. If you have a mortgage of 50,000 in the levered case, then you have to invest 50,000. Say you earn a rent of 12,000, so you're receiving 1,000 a month. So in the unlevered case, you pay no interest. Say in the levered case, you pay 2,000 in interest on your mortgage. And so your return on equity, actually, let me just say another one. In both cases, your return on asset is the same. Right? The assets of this deal is the house at 100. So the return on assets would be 12%. And in this case, it would also be 12%. But look what happens to the return on equity. The return on equity is the return not on the whole thing, not on the whole deal size, but on the amount of money that you're putting in. So when you look at the unlevered case, you had to put in 100 and you earn 12,000. That means that your return on equity would be 12. But look what happens with the levered case. If you're able to finance part of the building with a mortgage, which usually you can, because banks love to loan against a physical property, especially income property, because they know there's cash flow generated that is going to pay the mortgage. In this case, after you pay your interest, you're going to make a profit of 10,000, but your investment was 50,000. So the return on equity would be 20%. And that's why so many people buy income properties, because they're able to finance usually a big part of it, and the more of it you can finance, say if instead I was able to finance 80% of it, so my mortgage was 80,000, and so the equity I would only have to put in 20,000. So say now the interest would be about maybe 3,000 or 4,000. You can see that the amount of money that you're making stays pretty constant, or just a little bit less because of the interest, but it's a return over a much smaller amount of money that you had to invest into the deal. So the more leverage you have, the more return you have on your equity. The return on assets is always the same, but the more you leverage up, the more debt you have, the little bit that you're investing has that same amount of return against it, and so you end up getting a bigger return. So a 20% investment, a 20% return on an investment is pretty good, and it's not like a higher risk, high, tech startup. This is like a house, and there's people there, and they're paying rent every month. It's a pretty safe investment. That's why so many people do that, because it's a great investment. Although what happens after a while is, as more and more people do that, they push the price of the houses up. The more and more investors there are in the market, they end up pushing the price of the house up. So after a while, what happens is, like, there's an actual natural cap on that number, because the higher that number gets, the more excited, the more interested investors are into that investment, and then they'll bid up the price of the house, and then that has a lowering effect on the return on equity. So understand that concept of the difference between return on equity and return on assets has to do with the amount of leverage that you have. And so the way that people do this with houses, or apartment buildings or condos, that kind of stuff, what makes sense is not to wait until the entire mortgage is paid off by the rent. It's once you get to about 50% equity that say you start at, that one you start at 50, but typically, say you put in 20%. Once you get to having paid about half or a little bit more of half of that property, instead of continuing to pay up until the top, you're better to use that extra money and buy something else, because it makes the most sense to own these income properties when you're levered. Because instead of just getting the plain return on the asset, you juice up your return on the little bit of money that you put in, the 20%, by having more debt. So leverage, the other thing is that leverage amplifies the variation in EPS and ROE. Say if you, continuing with that example, if you're levered 10 to 1, meaning that you have, say if you're levered, say 9 to 1, 90% debt, 10% equity, then if the value of the asset goes up by 10%, you've doubled your money. Because say you've put in 10,000, and then the asset goes up from 100 to 110, well, you still have the 90 of debt, but you now have 20,000 of equity. So your investment just went from 10,000 to 20,000. You've doubled your money. That's a great investment. Here's the flip side of that. If the value of the asset goes down by 10%, you're wiped out. You lost all your money, right? Because you put in 10. If the price of the house goes down to 90,000, then that's what the mortgage is at. So if you go to sell it, you'll get 90,000, you'll pay off the mortgage, and you'll have zero left. You put in 10,000 and you lost it all. So that's what leverage does. It amplifies the return, but at the same time, it makes it more risky. What happened with banks when they got, this is a pretty neat trick, pretty neat financial engineering tricks. So what do banks do? They just kept bringing their leverage up and up and up and up and up and up. What happens, say, once you get to banks, like the big investment banks, got to around 20 to 25 times leverage in the before the crisis. What happens? If you're leveraged 25 to 1, then if the value of your assets go down by 4%, your equity is wiped out. And that's what happened with banks. They juiced up their return on equity for a bank is one of those very key metrics that people look at. And so what bank CEOs and bank CFOs would try to juice this up as much as possible, but they got to a point where in order to earn that extra return, they were taking so much risk. The risk that if the assets went down just by a little bit, we're not talking about, houses went, down by 50%. In the States, they went down by about 10, 20%. So if you have a bank that has a bunch of mortgages on their books, bunch of assets, and they go down by just a little bit, when you're very highly levered, you can get wiped out. So that's what it means by leverage amplifies the variation in earnings per share and return on equity. So one thing that you look at is, should I have more debt or less debt? So this is an example of the earnings per share that you would get as a function of what the EBIT for the company is. Right now we're just ignoring taxes. So this line here, that starts at 0, that's the unlevered company, right? The company with no debt. So when the EBIT is 400,000, then the earnings per share is $1. When the EBIT is 800,000, the earnings per share is $2. Right? For every amount of EBIT that you make, it corresponds to an equal amount that goes into the earnings per share. Now, if you look at the levered company, meaning the company that has debt, it's the second line at the bottom here, the one that starts at -2. So what this means is, it doesn't say in that example what the amount of debt that was taken on, but what this is saying is the interest payment per year on that debt is $2,000. Or sorry, $2 per share. And so if you have no EBIT, in other words, you just broke even, you still have to pay that interest payment. And so your earnings per share is going to be -2. At 400,000, normally your earnings, the graphic doesn't line up very well, but at 400,000, you're making just enough EBIT to pay the interest payment. Then if you keep going up, there's this very important point right there, which is called the break-even EBIT, or the break-even earnings per share. What that means is, below that point, you're better with equity, because you can see that the unlevered earnings per share is higher than the levered earnings per share. Above that point, what's going on is you're getting that leverage effect, so that it makes sense to have more debt, because what you're doing is you're increasing the earnings per share. So at 1.2 million in EBIT, when you have debt, then you'll have a higher earnings per share. So what you want to know is, where is that break-even point? At that break-even point, it makes no difference whether you go with debt or equity, with more debt or more equity. But the key concept here is not what's happening at that point. What it's saying is that point, below it, you're better with equity, where it says here, disadvantage to debt. Above that point, you're better with debt, because you're getting that that juicing up of the return. So you want to know, where is that point? Where is that break even? So it says on the side, find the EBIT where the EPS is the same under both the current and the proposed capital structure. So what this is saying is the unlevered is the current, and the proposed is the levered. If you expect, well, I just said the next two things. When EBIT is greater than that break-even point, you want more debt. And when EBIT is below that point, you want less debt. So how do you find that point? You want to know, where do those two lines meet? Well, you know what I'm going to show you in a second. We know what the equations of those two lines are. So we just set up an equation where one is equal to the other, and then we solve for the x value, which is the EBIT. So let me show you an example. Okay, so we have an unlevered firm, meaning no debt, with a market value of 1 million, has 50,000 shares outstanding. The firm restructures itself by issuing 200 new bonds with a face value of 1,008% coupon. The firm uses these proceeds to repurchase the outstanding stock. What is the break-even EBIT point? So let's just ignore taxes. So first of all, how much debt are we going to raise? We're going to sell 200 bonds at 1,000 a bond. So we're going to sell 200,000 of new debt. The interest payment is going to be 200,000. We have an 8% coupon, and so the interest payment is going to be 16,000. The price of a share, so it says that the company is worth $1 million, and there's 50,000 shares. And so the equity is worth $20 a share. And so, how many shares are we gonna buy back with the 200,000? 10,000 shares. And so now, what we want is to write down the equations of those two lines. So the first side of the equation, which is what you would call the unlevered earnings per share, is going to be what? It's going to be the EBIT that you make. And remember that in the unlevered case, earnings before interest and taxes, there is no interest. And we're just ignoring taxes for this problem. And so the amount of EBIT, the earnings per share are going to be how much EBIT you have divided by 50,000 shares. So that's the equation of this line here, the one that starts at 0. Then the levered EPS is going to be what? So you got your EBIT, but now you have your interest payment. So before you can pay out your earnings to the shareholders, you got to pay the interest payment first. And so you'll have EBIT minus 16,000 for distribution to shareholders, but we bought back 10,000 shares. So now we only have 40,000 shares. So this is going to be a little, well, I'm going to have to erase the top. So we have this picture. Here, that's your unlevered EPS. So here you have EBIT, here you have EPS. So the first curve is the unlevered EPS. The second curve is, or not a curve, but a line, is at minus 16. In the levered case, if you make no EBIT, you're still going to have to pay the 16,000 in interest. So when your EBIT is 0, the levered EPS is minus 16. Then the line goes up like that. So we want to know, you say what is EBIT, but in other words, what's the X value equal to here? So it's where this line and this line are equal. And so we have our equation, and now we just got to solve it. So I'll just continue, say, here. Now this is some basic high school algebra thing. If you have some issues, things that you need to get better with as you go into third and fourth year. But just to remind you, a trick, well, not a trick, but the technique to solve an equation like that is you cross multiply. But we're going to end up with some pretty big numbers, so let's just simplify first by dividing both sides, sorry, multiplying both sides by 10,000. So I'll be left with so this equation's still the same. All I did is I simplified it by getting rid of the thousands on both sides. You don't get rid of the 1,000 there. All you're doing is multiplying both sides by 10,000, and so it gets rid of the zeros in the bottom of the fraction. So now I cross multiply. So what this says is 4 times EBIT is going to be equal to 5 times EBIT minus 16,000. So that's equal to I can further simplify this by bringing that 4 EBIT on that side, so I'm left with 1 EBIT, and bring that 5 times 16 on the other side. So the answer is 80,000. So at 80,000, those two lines intersect. That's what's called the break-even EBIT point. So let's verify. What's 80,000 divided by 50,000? That would be, can somebody do that quickly for me on the calculator?
1.6.
1.6? Okay. Well, that should be minus 16 divided by 4,000. So. Then, can you do 80,000 minus 16,000 divided by 40,000? Exactly. So this is called, the 80,000 is called the break-even EBIT, and $1.60 is called the break-even earnings per share. So that's the break-even EBIT problem. So the next topic is what we call homemade leverage. Here's the idea. If there's an investment that you like, there's a company that you like, but it has too much debt. The investment that you want has too much debt. Or vice versa, the investment that you want doesn't have enough debt. It's not levered enough. What you can do is, you can go to the board of the company and say, you should have more debt or less debt, but they're not going to listen to you probably. What you can do is create, in other words, in a way, a synthetic portfolio where you either increase the leverage from the point of view of, homemade means from the point of view of the investor, or you can decrease the leverage by doing something else. You'll see in a second. So if you want to increase leverage, this is, by the way, the same thing as trading stocks on margin. Right? If you buy a stock and you're 50% margin, meaning say you buy a stock for $100, but instead of investing the $100, you put in 50,000. You put in 50. And then you borrow the other 50, and then you buy that stock. It's the same principle as the house example I showed you at the beginning. Right? You're increasing the leverage of the investment. The actual stock of the company, none of their debt position changed. But from the point of view of your portfolio, your homemade leverage has increased. So if you want to increase leverage, In other words, the debt to equity ratio or the weight of debt. What you do is you borrow and you buy some shares. And then what's going to happen is the personal debt that you have is going to combine with the company debt that you have in your investment to get the percentage of debt that you're trying to reach. The other way is if you want to decrease the leverage of an investment, you sell some. It's in a way it's like reverse margin, but you don't really do that. If you want to decrease the leverage of an investment, what you do is you sell some of that investment and you invest that cash that you got into some personal debt investment. So what happens is that personal, don't call it debt when you own it. Say the bonds that you have will cancel out the debt that the investment has to get the leverage that you want. Let's show you an example, actually 2 examples, it's going to make a little bit more sense. But these two, break-even EBIT, homemade leverage, and what we're going to do the rest of the chapter, they're all fairly technical, fairly difficult compared to the rest of the course. So here's the situation. An investor owns 500 shares of stock in a firm with a debt to equity ratio of 1. The investor prefers a debt to equity ratio of 1.6. If the stock price is $2 per share, what should the investor do? So you know that you want to borrow some money and buy some shares, but where do you start? What you got to figure out is the number that you got to solve for to get the number you're trying to get to is how many shares do I need to buy with borrowed money to get to that leverage. So let's look at it. So to increase the debt to equity ratio from the point of view of the investor, so the homemade leverage, what you want to do is borrow money and buy shares with that borrowed money. So the equity that you have before you have 500 shares at $2 per share. So you got $1,000 investment. That means that the debt related to that investment is going to be $1,000 because right now the debt to equity ratio is 1. So that means that if you have 1,000 invested into the equity of a company, that equity also has 1,000 of debt in front of it. So next, you want to get to a debt to equity ratio of 1.6. And so what's going to be the total amount of debt after you do this? Well, you're going to have 500 plus how many new shares you're going to buy times 2, because there's $2 a share of equity and debt to equity is 1, so you have $2 of debt that the company has for every share that you buy. And so the amount of shares that you're going to have after you borrow money and buy shares is going to be 500 plus how many you're going to buy. So that's the amount of debt that the company has. And you will also have 2 times. So if I say I buy 10 shares, 10 shares is going to cost me $20. And so I'm going to borrow $20. So this part is the personal debt, or call it the homemade debt. Homemade. So the total debt of your investment is the two of them together. What is the equity? Now, this and this is the same just by coincidence because you have a debt to equity ratio of 1. Don't try to learn a pattern to this equation where this part is always the same as this part, because it's not always true. If the debt to equity ratio was 2, then this would be 500 plus delta S times 4, but that bottom part, the amount of equity that you have, would still be 500 plus delta S times 2. So don't think that this part is always the same as this part. It's just a coincidence because debt to equity is 1 right here. So that's our equation. We want to know what is the amount of shares that we need to buy in order to make that equation work out to a debt to an overall debt to equity ratio of 1.6. So you just do again the cross multiply thing. So you multiply that into here. And you can simplify a little bit first the top. So this is going to be 1,000 plus 2 delta S from this and another 2 delta S from that. And you're going to have 1.6 times 1,000 plus right, so this is going to be 1,000, 2 delta S. So you bring that over here. So now you're left with an equation on one line. And then let's just further simplify this. So you have, how many delta S's do you have? You have 4 here, and then you have minus 1.6 times 2. 1.6 times 2. So that's going to be equal to 0.8. And then you just bring that 1,000 on that side. So you have 1.6 times 1,000. From this. And then you have that 1,000 that goes on the other side. So now you know that 0.8 delta S is equal to 600. And so delta S so that's why you need to buy 750 shares. And then knowing how much money you got to borrow, it's pretty easy. So it's $2 a share. So if you buy 750 shares, you got to borrow 750 times 2, which is 1,500. So the next example, so this one is where you want to increase leverage. The next example is where you want to decrease leverage. So an investor owns 500 shares of stock, debt to equity ratio of 1. The investor prefers an all equity firm. What that means is you want the debt to equity ratio to be equal to 0. If the stock price is $2 per share, what should the investor do? So if you want to decrease the debt to equity ratio, what you do is you sell shares and you lend out the money that you got. So you sell the shares, you get cash for those shares. Then you take that cash and you invest it into a debt instrument. And what it's going to do is cancel out the debt that the investment has. So again, that's why it's called homemade leverage, because from the point of view of the investor, you created a situation where you have your investment has less leverage than the stock that you bought. So in this case, so the same, you still have the equity that you have before is 1,000, and so the debt related to that investment is also 1,000. But now instead of going from debt to equity of 1 to a debt to equity of 1.6, what we want to do is go from a debt to equity of 1 down to a debt to equity ratio of 0. So you want to go the other way. So let's write what the debt to equity ratio is going to look like afterwards. So the debt that you're going to have it's still the same amount. Oh, sorry, it's minus here. But what happens is the personal part, I keep using personal, it doesn't mean that it's necessarily a person, it could be, a mutual fund or something like that, but I say homemade leverage, I talk from the point of view of an individual investor or a personal investor. So what's going to happen is if you sell Delta S shares, say I sell 10 shares, I'm going to receive $20 for those shares. I'm going to invest it into a bond, and what's going to happen is it's going to reduce. So this is again the company debt. I'm putting this over the negative sign because what I mean is because of the fact that you're investing into a bond, what that debt that you're an investor in is going to cancel out with the debt of the company. So the amount that you're going to invest if you sell Delta S shares, then you're going to have 2 times the amount of shares that you sell in a bond investment, and that's going to cancel out the debt of the company. And we want that to be equal to 0, and the equity is still the same. Well, actually, not quite the same because now it's minus delta S times 2. So now we want to solve this equation for delta S. Now, the trick here is not cross multiply for the fraction, but it's to know that when you solve an equation where, say you have a function of x divided by anything is equal to 0, doesn't matter actually as long as the a, what you're dividing by is not 0, then all you want is the top to be 0. In other words, it doesn't matter what's at the bottom, because the only way that you can make that fraction equal to 0 is if what's at the top is equal to 0. So, solving that equation here is a little bit simpler than the last one we did. So rewrite the top here. You have 1,000 minus 2 delta S, and then minus 2 delta S is equal to 0. So if I simplify further, 4 delta S is equal to 1,000, and so delta S so you need to sell 250 shares, and if you sell 250 shares at $2, you'll get $500, and that's what you're going to invest into a bond. The best thing to do is if that company actually has a bond, not all companies have bonds. Sometimes their debt might be bank financing, it might be a private placement, it might be something else. Might be financing, say, from a parent company or something like that. So here, you got the 250 shares, you sell them for $2, and you get 500. When you put that 500, like I said, if you put it into the actual bonds of the company, you would have a perfect hedge, right? The risk here is if you have a situation where the company that the stock of that company that you're investing in doesn't have debt that you can invest also into, then you have to go and invest that 500 into debt somewhere else. So it doesn't perfectly balance. But if you're able to take that 500 and loan it to the company, you are setting up a perfect hedge because you've balanced the extra debt of the company that you didn't want by the cash that you got from those shares that you sold, and now your net debt position is going to be equal to 0. Because if you sell 250 shares, we started with 500. So if you sell 250 shares, that's going to be worth 500. And then that company has 500 of debt, for that 500 of equity that you have, but you're also have 500 invested into a bond, so the 500 of debt of the company cancels out with the personal or the homemade debt investment into debt, so that the net debt would be equal to 0. And so from the point of view, the homemade point of view of the investor, what you did is you created an investment that has a leverage of 0 from a company that had debt. So that's the point. That's the concept of homemade leverage for the two sides. So here's a good point to take a break. Okay, so it's 7:21. Let's continue. So now I get into 16.3, which is capital structure theory. And this is probably one of the toughest part. The next 2 subchapters, probably one of the toughest parts, like I said, together with the international business stuff, international finance stuff, sorry. 2 of the most difficult topics in this course. So let's talk about a theory of capital structure. So remember that the question we were trying to answer, if you're a CFO, is how do I choose my capital structure? I want to maximize the value of the company. So what we want to do is we want to study how does the changes in capital structure affect the value of the company. Like, is the company worth more if I have more debt? Is the company worth more if I have less debt? And so on. And so the two guys, Modgliani and Miller, I think that was in the 50s, 1951, something like that. It's a big theory in finance. Those two guys got the Nobel Prize for it. And in fact, what you're learning right now, or what you're going to learn in the next 2 years, third and fourth year, most of these things, the whole body of work, the framework that we call modern finance, there's a couple of big parts, and then most of them, were about 1950 to 1970. All of these things came out. You have Modgliani and Miller, the theory of capital structure. You have the CAPM. I can't remember what the guy's name was that did the CAPM. And you have Black and Scholes for option pricing, and you have it's HJM. I can't remember what the J and the M stands for. Anyway, it was three guys. I think one was Morton or something like that for interest rates. So all of these theories put together, the CAPM, the theory of interest rates, the pricing of derivative of options from Black and Scholes, and the Modgliani and Miller theory of capital structure, those papers or those pieces of research put together forms what we call modern finance. And more or less everything that you're going to study in third and fourth year is based on the work of these 3 or 4 different groups. So how do these guys go about building a theory of capital structure? Well, first what they said is, we want to look at 2 different things. We want to look, as the capital structure changes, we want to see how does that affect the value of the company, and at the same time, how does that affect the average cost of capital? So the value of the firm is determined by the cash flow to the firm and the risk of the assets. That's the, call it, EBIT divided by WACC. So the top part is the cash flow. The bottom part measures the risk, because remember, higher risk, higher return. So the riskier a company is, the higher its cost of capital is going to be. Like if you're buying, a student ghetto house and you're putting a mortgage on it on Sunnyside Avenue, this is a pretty low risk investment, because you're pretty guaranteed that you're going to be able to rent out to students. It's not going to be, you might have some, hassles, but this is a pretty low risk investment. That's why so many people get involved into the owning of rental property, because it's a decent way to make money without too much risk and without too much active work. Like if you rent out a building to a residential tenant, as the owner, you don't need to be there every day 9 to 5. If you own a business, you got to be there 9 to 5. So it's a pretty good investment to have rental property. That's why so many people do it. So the value of the investment is the cash flows divided by the risk. That's what that second thing says. Now, if you have, say, your business is to drill to try to find gold in, say, around Iqaluit, that's a pretty high risk type of investment. So your average cost of capital might be 40-50%, whereas the investment into rental property, an average cost of capital is going to be around 5 to 10%. That's a pretty low risk investment. We talked about last week venture capital. In general, venture capital deals, so an example, or angel investors, examples being Dragon's Den, they look for an average cost of capital, or the required return on the order of 50%. Venture capital, we use the expression, it's a 51-50 deal, meaning that the venture capital company wants 51% of the stock, so they have control, and they're looking for the return when they look at a project and the kind of return that it's going to bring. They're discounting those at 50%. So a 50% return is a venture capitalist, angel investor type of return. Mortgages nowadays are what, like 3 to 5% or so. In the mid-risk part of the curve, you have, say, credit cards at around 20%, and so on. So the riskier the assets of the company, the higher the average cost of capital is going to be, and therefore the less the company's worth. Here's an example from what I do at Sunbelt of a company that's worth a lot of money, even though it's not making that much, but it's worth a lot of money because it has very low risk. We're dealing with a company that does road construction. They fix roads for the Ministry of Transportation in Ontario. They just got a contract for, instead of the government each year going and doing a bidding process to find who's going to fix the road that year, what they're doing now is they're handing out 12-year contracts. Fixed amount for each year. So that business, it's going to be extremely easy to find a buyer for that business, because think of it, the cash flows, they're not 100% guaranteed, but almost, right? Because you don't have for the next 12 years to go and do some sales and get some projects. You know you're going to get that amount, and it's a fixed amount each year, and you know for sure you're going to get that amount. So that's a very low risk business. And so in that case, the return that would be associated with a very low volatility type of cash flow would be lower. And so if you're dividing by a number that's smaller, the overall fraction is going to be bigger. So if you have two companies, one of them generates, you're 99% sure that you're going to get 10,000 each year, and the other one you're only 50% sure that you're going to get 50,000 each year. Which one's worth more? Anybody? The one where you know for sure you're going to make that money, or you're almost sure. So the lower the risk on the assets, the higher the company is worth, even though the cash flow at the top might be the same. So what changes the firm value? I just talked about that. You change the risk of the cash flow, or you change the cash flow. So before I continue, just what modgliani-miller were looking at was, how does capital structure affect the firm value, the value of the company, and the cost of capital. So what they did is, this is pretty common when you develop a theory of something, especially when you're dealing, say, with a real world subject matter where things are pretty complicated. What you want to do is you want to simplify the situation, simplify the model as much as possible to get it down to a level of complexity where you can understand something and figure out something. So the genius of modgliani-miller was, instead of trying to tackle the full, let's figure out what the optimal capital structure is, right off the bat with everything in, what they did is, let's simplify things, let's figure out a couple of simple things, and then let's build back up. This is a pretty standard technique in developing a theory of something or learning something. I don't know, how many of you have ever taken physics course? Yeah. So remember that one way that people teach physics, say in high school or first year, to simplify things, is you assume that friction doesn't exist. And so the equations for motions are pretty simple. But once you account for friction, that's stronger the faster you go, like the equation gets a lot more complicated. So that's what modgliani-miller did. They said there's two levels of complexity that we got to tackle. First is taxes, and the other one is bankruptcy. So what they did is they came up with three cases. The first case is we're just going to look at it from the as simplified as we can. So we're going to assume that there are no taxes at all. It'd be a great world to live in, but it's never going to happen. Then the second thing is we're going to assume that a company cannot go bankrupt. And from that, they were able to come up with a couple of concepts, which I'm going to show you in a second. Now, with this Modgliani and Miller stuff, what's confusing to students is the difference between cases and proposition. Proposition is about what equation you're looking at, and cases are what level of complexity you're in. So what you have is case 1, proposition 1 and proposition 2. Then you have case 2, proposition 1 and proposition 2. And then you have case 3, proposition 1 and proposition 2. Students have quite a bit of hard time, mixing up the cases from the proposition. So what we're going to do is start with case 1. I'm only probably going to get through case 1 today. And this is the most simplified situation where there's no tax and no bankruptcy. So now what we're going to do is let's look at what does the value of the company look like in that highly simplified case, and then what is the cost of capital of that company look like in that, again, that simplified case. And then what's going to happen is once you've figured out that part, then what you do is you just throw in throw the taxes back in. So the technical expression is you relax the assumption. So in the first one, you assume that taxes don't exist, and then you figure things out. Then what you're going to do is relax that assumption and put the taxes back in and see how does that change the equation that we had before. It's a genius way of building a theory because they probably would have never been able to figure out the complicated case 3 right off the bat. But by using this technique of simplifying, figuring things out a little bit, and then building up on it, they were able to build to a pretty important complex theory by starting with something very simple and then one at a time pulling out the assumptions until you get to case 3, which is an accurate representation of the real world. So for proposition 1, which is the equation about what is the value of the company, what this says, and that was the first thing that they figured out that was quite important and quite interesting, is that when there are no taxes, it doesn't matter how much equity and how much debt you have, the company is always worth the same. What I'm saying, the company is worth whatever, I'm talking about the enterprise value. So the total value of the equity and the debt put together is going to be equal. What they're saying is this. If I start with an all-equity firm, in other words, the whole enterprise value is all in equity and there's no debt, then the company is, say, worth something. So say that's the area of that circle. What they're saying is this. No matter how you split it, again, remember that we're in case 1, so we're assuming that taxes don't exist. So no matter how you split it, so that would be debt to equity ratio of 1. So this is a debt to equity ratio of 0. Weight of equity is 100%. Weight of debt is 0. Here, debt to equity ratio is 1. Weight of equity is equal to the weight of debt is equal to 50%. And in this case, debt to equity ratio is 3. So the weight of equity is 1/4. And the weight of debt is 75%. What M&M Proposition 1 says is it doesn't matter how you split that pie, the area of the pie is always the same. In other words, by, say, increasing the debt, I don't end up with a situation like this, where the company that's all equity, say, is worth that much, and then the company with, more is worth more, and then so that's not what's happening. As you change the split between debt and equity, the total area, the total enterprise value always stays the same. So that's the equation here. So the value, U is for unlevered, so the value of the company unlevered is going to be the EBIT divided by the return, the rate, the discount rate, whatever, in the unlevered case. That is equal to the levered firm. The area of the pie is the same, and the value of the levered firm is the equity in the levered case plus the market value of debt. But once you add debt, the debt plus the equity in the levered case is still going to be equal to the value of the company when it has no debt. So in other words, the enterprise value stays constant, even though the shift, the proportion of debt versus equity changes. So let's do a simple example here. So you have a company that's an all-equity firm, and it has 500,000 shares of stock. The company is going to borrow $8 million at 9% and repurchase 200,000 shares. So what is the value of this firm if you ignore taxes? What I'm going to show you is that the value of that company stays the same whether you're before at all equity or after with the debt. So the price today, the company is worth, you're gonna buy back $8 million worth of shares, and you're gonna buy back 200,000 shares. And so right now the stock is at $40 a share. So the value unlevered of the company is when it's all equity. In that case, that's going to be the amount of shares in the unlevered case times the price. So you have 500,000 shares at 40. So that's 20 million. So in the unlevered case, the company is worth $20 million. Now, you take $8 million and you buy back 200,000 shares. So before, you had 500,000 shares and no debt. Afterwards, you're going to have 300,000 shares, but 8 million of debt. This is a restructuring that's increasing the leverage, because what you're doing is you're raising new debt and you're buying back stock. If you wanted to go the other way, if you want to decrease the leverage of the company, what you would do is you would raise new equity, take that cash, and buy back some of your bonds. And then that way, that would be a decreasing leverage restructuring. So the value in the levered case is going to be the value of the equity in the levered case plus the debt that you have. So now you have 300,000 shares because you bought back 200,000. And you have $8 million worth of debt. And surprise, surprise, the total enterprise value is still 20 million. You went from having equity of 20 million to having equity of 12 million and debt of 8 million. So the enterprise value is still 20 million. That's the key insight of Modgliani-Miller Proposition 1. I talked about that already. So in case 1 there, in Proposition 1, the value of the firm is not affected by changes in the capital structure, and the cash flows are not changing. This is what people would call a financial engineering trick. Right? The company is still selling the same products, it still has the same employees, still has the same customer, it's generating the same amount of EBIT. It's just that now the way that it's financed, its capital structure has changed. But the actual cash flow is going to be the same. Proposition 2 is the average cost of capital is not affected by the changes in capital structure. Here's what's happening. This here, I show it. So now we're still in case 1, where taxes don't exist. But instead of looking at what is the value of the company, I'm looking at what is the cost of capital of that company. Now that equation there should look familiar with the WACC equation for the from chapter 14, but you'll see that you don't have the 1 minus t at the end here on the cost of debt because there are no taxes. You could think of 1 minus t, but t is 0, so you're just multiplying by 1. So that's what's going on. That's the equation for the average cost of capital. If you take that right here, you can rewrite that equation in terms of the cost of equity. And so the cost of equity is the cost of RA means the return on assets, the ROA, plus the spread between what debt is costing you and what your return on assets is, multiplied by what the leverage of that you have. So what's happening here is this. The average cost of capital doesn't change. Obviously the cost of debt, in reality, this is highly simplified. What happens in real life is as a company has more and more debt, as it's more and more leverage, banks are not going to loan. They're going to start loaning at a higher rate because it's more risky. But we're just, assuming a very simple kind of theoretical example to figure out what's going on. But the cost of equity goes up. The more leverage you have, the more debt you have, the cost of equity goes up. Here's the reason why. Remember that debt has a priority on the claims of a priority claim on the cash flow of the company, right? They have higher precedence for getting paid their interest and their principal. In other words, the bondholders have to get all their money back. They have to get their interest payments and their principal payments before the equity holders can get anything at all. Right? Equity, in a way, is a residual claim on the cash flow of the company. After all the debt have been paid, whatever is left is what the owners, the shareholders of the company own. And so, as you're going up in debt to equity ratio, the equity is more and more risky. Because if there is no debt in the company, then whenever the company makes a dollar, that dollar goes to shareholder. But if there's some debt ahead of the equity, then the debt holders are going to get the money before the shareholders will. And so the shareholders have a higher risk because they only get paid if the debt people get all their money and then they get whatever is left. As you go higher and higher, the claim of the equity people is lower. They have less and less precedence. In other words, all those debt holders, all that debt has to be paid back before the equity holders get even 1 cent. So if you go, say, to the extreme case, where say you have 90% debt and 10% equity, the only way that the equity people there would get any return at all is if all the debt got paid back and then they get whatever is left after that. So you can see that as you have a higher and higher leverage, in other words, more and more debt, the equity becomes more and more risky. The little bit that's left, as that goes like this and like that and more, that equity becomes more and more risky because you're behind more and more debt. But what happens is the actual average of the whole thing stays the same. In other words, the cost of debt is always the same, right? You're still paying 5%, 8%, whatever, no matter how much debt you have. But the cost of equity goes up. And so what happens is you have, say, a big part like that, that's the cost of equity unlevered. Then in this case, the cost of equity would be equal to the return on assets. In other words, the ROE is equal to the ROA. When there's no debt, the return on equity and the return on assets is the same thing. So once you go up to this, the price that you pay on the debt always stays the same. But the cost of the equity goes up so that the overall average of the whole pie stays equal. That's the insight of Modgliani-Miller Proposition 2 in the case of no taxes. And so, as you have more leverage, well, it doesn't have a picture for the value of the company, but it stays the same. And then the cost of equity goes up, but the average stays the same. Because what happens is, RD is always the same, but now it takes a bigger part of the pie. And RE goes up, but at the same time it takes a smaller part of the pie so that the overall average, the average cost of capital, stays the same. Let's see, did I miss an example? Okay. So let's look at an example. Case 1. The required return on assets, so the ROA is 16%. The cost of debt is 10. And the percentage of debt is 45. So what is the cost of equity? It's going to be 20.91%. So do I have that picture? No. So this is what's happening here. So the return on assets is 16%. The cost of debt is 10. Now that's not going to change no matter how much debt you have. At least the way that we're looking at it here. The cost of debt is always 10%. Now, at a debt to equity ratio, well, it says percent of debt is 45. So that's a debt to equity ratio of what, about 0.9? Yeah, there's 45. There's 45%. There's 45 of debt to 55 of equity. Can somebody tell me what that fraction is? 45 by 55? 4?
0.8182.
0.81? Okay, so at a debt to equity of 0.81, at this point, so think of it as, A plus BX, the equation of a line. That's your A, that's your intercept. RA minus RD is your slope, and your debt to equity ratio. So in other words, that's your A, that's your slope, and that's your X value. So at a debt to equity ratio of 0.81, the cost of equity is 20.91%. Now, the average cost of capital is always going to be the same. The average cost of capital is always going to be 16. So that's what that first equation is saying. Now, suppose instead that the cost of equity is 25%. What is the debt to equity ratio? So what they're asking here at the second part is, if the cost of equity is 25, what is the debt to equity ratio that gives you a cost of equity of 25? So what you do now is, instead of having the equation where you plug in the numbers and you get the answer, you still write that same equation, which is this one. But now instead, you know the cost of equity, you know the average cost, the WACC, and you know the spread of the WACC above the cost of debt. And what you want to do is solve for what that debt to equity ratio is. Don't think of D and E as two separate variables. Just think of DE as a single variable that you're solving for. So this is just simple high school math. You solve for the debt to equity ratio, and that's equal to 1.5. So based on this information, what is the percent of equity in this firm? Well, if the debt to equity ratio is 1.5, remember this equation? Weight of equity is 1 plus debt to equity ratio. So if the debt to equity ratio is 1.5, then the weight of equity is 1 divided by 2.5, which is 40%. So next, how does financial leverage affect systematic risk? So another way to write the cost of capital for a company is using the CAPM. So a return on investment, the theory of the CAPM says that that return is composed of two parts. A risk-free return plus a spread above a risk of some kind. So beta measures risk, and it multiplies into the spread between the average return on the market and the risk-free rate. So what you're doing is not just multiplying beta into what the average of the market is. What you do is you multiply beta into the spread of the average of the market above the risk-free rate. That's the CAPM. So beta measures the risk of the asset of the asset of the company. Now, in proposition 2, what you can do is replace that RA with the equation of the CAPM, and you assume that the debt is riskless. In other words, RF is equal to RD, and you're able to rewrite that equation from before as RE is the risk-free rate plus the beta of the assets times 1 plus the debt equity ratio plus the spread, the market risk premium. And so what that says, if you keep simplifying things, you get to this equation here, which is quite important. And what it says is the beta of the equity is the overall beta of the company multiplied by the financial leverage. So, in other words, the risk of the stock of a company has two components. It has the overall risk of the business, so it could be competitors, new government regulation, employees quitting, all these kinds of things. That is the inherent risk, the core risk of the business. But there's additional risk from having more and more debt. Remember that the more debt you have, the less equity you have, and so that equity is more risky. And so what it says is the beta of that riskier equity is composed of just the general risk of the company, call it business risk, magnified by what the risk that you take on from having the extra debt. So there's two parts, the systematic risk, so the main risk, the beta that you've seen before, and the additional risk of having that leverage. That's another important equation. We'll take a break here. So let's do an example of, we're in case 1, so no tax. Proposition 2, so we're looking at the cost of equity. And so the cost of equity is the RA and wax the same thing. So this is a pretty simple question. It's just a matter of plugging in the numbers. So RA is 15. Cost of debt is 8.5. And debt to equity ratio is 0.75. And so the cost of equity is 19.88%. Remember that when we talk about percentages in finance, you always go to 2 decimal places, and those are called basis points. So the way that you could read this would be either 19.88% or 1988 basis points. The way that finance works is people round out after that, but they always use 2. So in a midterm or final, I'm gonna tell the TA to take off a couple marks if you put either 1 decimal or 0 decimal or 3 decimal. Because in finance, it's always set in cement. That's how the computers have been programmed for 50 years. It's always 2 decimals below the percentage. So the next example is, remember we came up with, as the risk of the company goes up because it has more debt, that has a magnifying effect on the beta of the company. So the beta of the equity is the business risk plus the leverage risk. And so if you have so in this case, the asset beta is 0.95, and the debt to equity ratio is, well, it's not giving it to you. It's saying 60% debt, 40% equity. Well, here's the way you write this. You have 60% of debt to 40% of equity. So that's how you can get your debt to equity ratio. And so what this says is, if this company had no debt, so 100% equity, then the beta of that equity would be the same as the overall beta of the company, and it would be 0.95. By leveraging up to 60% debt, you increase the risk as measured by the beta. The beta of the equity goes from 0.95 to 2.375. So now, I'm not going to get very far into it, but I'm going to start case 2. So remember that modgliani-miller, they tackled this very difficult problem by simplifying the whole thing. So now we go from case 1 to case 2. And so before, in case 1, we assumed that taxes didn't exist. So in case 2, we put the taxes back in, but we still assume that bankruptcy doesn't exist. So we're slowly building up the complexity of our model to reach a realistic representation of the real world. So we're halfway through the development of the theory. So here's the key point. Interest is tax deductible. So now taxes exist. Interest is tax deductible, dividends are not. That's one of the key differences between debt and equity. Because it's tax deductible, if, say, your cost of debt is 10%, but your tax rate is say 25%, then what you're actually paying in after-tax dollars on your debt is not the full 10%, but it's 7.5%. So, as a firm adds debt, it reduces taxes because you will have a deduction for the interest payment that you made. That reduction in taxes increases the cash flow of the firm. Right? If you make the same amount of money but you pay less taxes, you're making more money. How should an increase in cash flow affect the value of the firm? So let's look at two cases. So you have the unlevered firm, no debt, and the levered firm, meaning with debt. In both cases, their day-to-day operations are generating the same amount of EBIT, 5,000. In the case of the unlevered firm, that means that you have 5,000 in taxable income. You pay 34% of that in taxes, so your net income is 3,300, and so your cash flow from assets is 3,300. In the unlevered firm case, you're still making 5,000 in EBIT, but now earnings before interest and taxes, we now have interest of 500. So the taxable income is 4,500. So you're only going to pay 1,530 in taxes instead of 1,700 because you have the tax advantage of debt versus equity here. And so your net income is 2,970, but the cash flow from assets, remember that cash flow from assets is cash flow to shareholders plus cash flow to creditors. And so that 500 that you pay in interest, that's cash flow that went to debt holders, but that's still part of the enterprise value of the company. In the case of the unlevered firm, you have 3,300 of cash flow that goes to shareholders, and there's only shareholders, there's no debt holders. In the levered case, you have 2,970 that goes to shareholders, and you have 500 that goes to debt holders, and therefore the total cash flow from assets is 3,470. So you can see that by having that deduction of 500, which is called an interest tax shield, it's similar to the, remember in the beginning of the course we talked about the CCA tax shield? So you have CCA, and then the tax shield is the amount of tax that you save from having that deduction. You have the exact same concept here, except that now we're talking about interest instead of CCA. So by the fact that you have that $500 deduction, that reduces your tax payable. And it's called an interest tax shield. So this is an example that's continuing from, I think that was this one here. So if the company has 6,250 at 8% coupon, then the annual interest tax shield would be, well, you pay 500 in expense, and because your tax rate is 34%, then you will pay 170 less in taxes. That's the difference between your 3,300 and your 3,470. It's that interest tax shield. So you save 170 from having that tax shield. Now, what is the value of that cash flow? Remember that a reduction in a cash outflow is the same as a cash inflow. So what is that cash inflow? What is that worth? Right now the company is generating 500 more of cash each year. So you would expect the company to be worth more because it's generating more cash. So what is the value of those savings brought back to the present value? So you assume perpetual debt, that's just for simplicity. So the present value of a perpetuity is, remember the from 2504, you have present value of a single cash flow, present value of an annuity, and then present value of a perpetuity. So the present value of a perpetuity is just the cash flow divided by the rate of return. And so in this case, the cash flow is, we're going to receive 170 in tax savings each year forever. And we're going to discount that at the cost of debt, which is 8%. And so that 170 forever in today is 21.25. So the present value is the amount of debt that you have times the cost of debt. So that's 500. So D times RD is 500. D times RD times TC is 170. And then you discount that infinite series, that perpetuity, at the cost of debt. What happens is the cost of debt that's here at the top of the fraction cancels out with the cost of debt that's at the bottom of the fraction, and you end up with the present value of those tax savings is just the amount of debt that you have times the tax rate. Because it was the amount of debt that you have times the cost of debt times the tax rate divided by the cost of debt. And so when things cancel out, you're only left with the present value of the interest tax shield going forward is worth D times TC. So the debt is 6250 times 34, you get to that 2125. So the increase in cash flow is exactly equal to the interest tax shield. I've already said that. So let's show you an example of interest tax shield. And again, don't confuse, it's the same thing as you have CCA and then you have CCA tax shield. It's the same thing with interest. You got to be careful from confusing the deduction itself from what it saves you in tax from what is the present value of those savings through the whole life. So the interest tax shield here is going to be equal to the debt times the cost of debt times the tax rate, which is 250. The coupon on the debt's 7, and the tax rate's 35. So the interest tax shield is 6125. So if you have 250,000 of debt, then the annual savings in taxes payable is going to be 6125. So what happens? The value of the company will go up by the present value of the interest tax shield. This is in case 2. Remember, in case 1 it didn't matter. But in case 2, the value of the company with debt is worth more because of those tax savings from having interest payments instead of equity. So if you assume perpetual cash flows, the value unlevered is EBIT times 1 minus the tax rate divided by your unlevered cost of capital. And then the value levered is whatever the value unlevered is plus how much debt you have times the tax rate. So the difference between case 1 and case 2 is this. In case 1, should write it as a table. So in case 1, it was EBIT divided by RU. In case 2, and then the value levered was still the same. In case 2, the value unlevered is this, and then the value of the levered company is still that same thing, so EBIT 1 minus T divided by RU, but it's worth the extra savings of the interest tax shield on top of that. So that's the difference between, for proposition 1, between case 2 and case 1. You have the 1 minus T at the top that's extra, and you have plus D times T because of the interest tax shield. So here's an example. Actually, I won't do the example. I'm just going to show you the picture and then we'll wrap up for tonight. It's going to be a nice way to chain with the next time I'm teaching this. So what happens is this. If you plot the value of the company versus the debt to equity ratio or total debt, when you're in case 1, it doesn't matter what the amount of debt that you have, the company is always worth the same. What happens with case 2 is for every bit of debt that you have, you increase the value of the company because of the tax savings of having the interest tax shield. Now, what you're going to say is, this is ridiculous. What this is saying is, the more debt I have, the more the company's worth. But remember that we're not yet at the realistic model. We're still at the intermediate model where we just put in taxes, but we haven't put in the risk of bankruptcy yet. So in case 2, where we assume that bankruptcy doesn't exist, the more debt you have, the more the company's worth, because of you have more and more interest tax shield. And then I'll just give you the punchline. What happens is, once you throw in bankruptcy, the more debt you have, the value of the company goes up because of the extra value of the interest tax shield. But what happens is, once you throw in the risk of bankruptcy, the more and more debt you have, the forces of the risk of bankruptcy then comes in, and the more and more debt you have, the more and more risk of bankruptcy you have, and so it bends down the curve. So we started with case 1 is just a flat line. Case 2, it's a straight line that goes up forever. And then case 3, which is the realistic one, is there's a certain amount of debt and equity which is optimal. And that's what the optimal capital structure of a company is. So I'll finish that after spring break. If you're going on the trip, enjoy yourself. And I'll see you in 2 weeks.